In this video, we're going to talk about the difference between a stock and a bond, cover both the pros and the cons of each type of investment, and clarify some of the language used around these financial instruments to make it really simple and understandable. Stocks get all the headlines. They're also sometimes called equities, but you should always understand them as a share of company revenue. That's why it's called buying a share of Apple or Amazon or AT&T. Bonds, on the other hand, are debt. They are a loan issued to a company or a government, and that debt, like debt that you might have, is paid with an interest rate for the loan that is received. Here's my favorite analogy to make this really simple. If I were buying a share of you, I would be getting a piece of the money that you make after all of your basic expenses are covered. That has the potential to be really valuable. If you were to 10x or 100x your revenue at some point in the future, I could make a really substantial return. If I were to issue you debt for a credit card or student loans, I would be paid back before you would pay that person who had a share of your future income, but my return would be capped to just the total that I loaned you plus the interest rate that we agreed upon. That interest rate would change depending on the nature of the risk. If I'm loaning you money for a house, I can give you money at a low interest rate because I can take that house if you fail to pay. But if I issue credit card debt, I have to charge a relatively high interest rate because of the lack of collateral ensuring that I will be paid back. Corporate or government debt works the same way. Companies with a lot of assets on their balance sheet and a low risk profile are able to borrow money at a lower interest rate. Think about a country like Germany or Switzerland, or a company like Microsoft with lots of clients, lots of revenue, and long contracts with those clients. Higher risk entities include countries like Afghanistan or Argentina, which has defaulted, not paid, its bonds multiple times in the last couple decades. It could also be a company with loads of debt already on its books, or an impaired business like Airbnb was in March of 2020. Good bond investors are able to ascertain the correct amount of risk associated with loaning an entity money and take advantage of dislocations where the risk is misjudged by the market generally. Stock investors, on the other hand, are able to see upside opportunity where others are not. Because it is a call on future cash flows, those that saw the potential in a company like Apple or Amazon before anyone else were paid handsomely for that foresight. When folks get excited about a new IPO, or Jordan Belfort is slinging penny stocks in the movie The Wolf of Wall Street, they are selling a story of future stratospheric growth from something that starts very small. The hope, the dream, the vision that the sellers of that stock are selling to their buyer is the idea that one day it could be something like AT&T. AT&T has an enormous moat in their business, a telecommunications network that spans the continent, and millions of paying subscribers that cut them a check every single month. Because of that predictable cash flow into the future, and their profits on hardware that was established long ago, they're able to issue a consistent dividend to their shareholders who get paid handsomely quarter by quarter. The main benefits that people are interested in when they buy stocks are their ability to collect those dividends or realize substantial, sometimes even 10x growth into the future. The downside is your investment can go to zero and you are not in a place of primacy. Just as your credit card and mortgage have to get paid back before you go spend on other things, the same is true with debt. When a company is struggling, like Hertz going into bankruptcy, it is their debt holders, their bond issuers, that are paid first. They're not always made whole, but they do get pennies on the dollar even when the company collapses from the existing assets being sold. Equity holders, on the other hand, are paid nothing when the company goes to zero. Two of the downsides associated with bonds are a different level of liquidity and interest rate risk. When interest rates go up, it makes old bonds with low interest rates less appealing. The downsides to investing in bonds include limited upside. That coupon rate, that interest rate that's being paid back, is the most that a bond will ever pay you. Most investors keep it in their portfolio because of the security and the insuring of their assets should a market downturn occur. If that market downturn does occur, then those bonds can also be privy to liquidity risk, meaning bad bonds are very hard to sell. The other downside to stocks, in addition to being subservient to debt in the case of a company going down, is the fact that it is substantially less quantifiable. While debt works much more like a math equation, $100 in, 5% interest rate, 105 being paid at the end, it is exceptionally hard to predict what the future will hold for a specific entity. Because of that and the wider variance of the market's perceptions for what a company can do, you can find yourself being right about the future and not being compensated for it because the market has not come to agree with your view on that stock. Stocks and bonds have made up the foundation of most investors' portfolio for the last century. But these days, commodities, real estate, and crypto are all getting a lot of love. Let me know in the comments what you think the optimal portfolio breakdown is, and hit subscribe because in a future video, we will be covering all of those and options. Thanks for watching.